Let's talk about vacating your current home in order to purchase a new primary home. So, in other words, I'm going to move out of the home that I own, that I live in. I'm going to go buy another property to live in. And I now want to rent out my current home. Let's talk about that scenario and how to use that rental income. So, before we get into that, if you are thinking about that, if you haven't already, check out, and I'll put a link somewhere around here. I have 3 questions for the individuals that want to keep their current homestead as a rental. So check out the video around here about those 3 questions, and make sure your answers are in line with whether you should or shouldn't. So if you're unsure or you'd like a different perspective, either one, call us, or two, check out that video. So assuming you are going to keep it, right? That's what this video is about. So assuming you are going to keep your current home, use it as a rental property. Now you need or want to use the income on that potential rental income to then qualify for the new house. So various programs. I'm going to give you the answers specifically, but I'm also going to kind of be vague because, again, each one's so different. I don't want to get into the minutia of actually becoming a loan officer. But in general, here's what needs to happen. Generally speaking, you will need to have your current home leased. So it's really hard from a timing perspective because it's really hard for you to go find the new home, get out of this home, get an executed lease, because otherwise you're going to be sitting there showing the property for lease while you're still living in it. So a lot of times the timing makes this tough, but you need to, one, have an executed lease. Two, oftentimes to prove that the lease is real, they're going to want to say a deposit of the first month's rent, right? Whether it's deposit or the actual first month's rent. And then three, and this is the kicker, depends on the program, but they're going to want to see between 25 and 30% equity within the home. So in other words, if you just bought the home last year, you put down a few bucks, it's going to be really hard to get that done for conventional financing because, again, they're going to want to see 30% equity in your home. So if the home's worth, let's say 500 grand, they're going to want to see, what is that? $150,000 of equity in that home on a $500,000 home. They want that 30% equity sitting in the home. So how do they verify that equity? Again, based on the program, but they're going to want typically like either an appraisal to verify the value of that home, or they might do some sort of what they call an AVM, like an automated valuation model. So in other words, a computer based on data they have. So maybe if the computer has enough data, they won't need it. If they don't have enough data, they might have to send an appraiser out. And then the appraiser might also get what's called a 1007, and that's just the rental analysis on top of an appraisal. So that cost for both those things could be $800, $900 more for closing costs to verify not only the value, but the rent associated with it. Now, FHA, so Fannie and Freddie is what we've been talking about, the conventional financing. FHA says you might only need 25% of equity in the home in order to use that new rent. So VA, just to cover the programs, VA, they're going to say that the equity may not be required, but it's really tough. They're not as it's not as automatic, so to speak. It's going to be subject to the lender verifying some information and all that other stuff, but they're a little more strict because here's why they're strict with VA. They're not going to give you credit for the rental income, which doesn't make a lot of sense because it's like, why even go through, like, that's the whole point of trying to use this rental income. VA, again, it's really tough. USDA, even harder. So there you have it. So in short, you need about 25 to 30% equity position in the home. And here's the last piece. That's the kicker. You're like, okay, I got this. I got the equity. I got the signed lease. I got the first month's deposit. The reality is the kicker could be this. You only get to use 75% of the rent. So if you sign a lease agreement for, let's say, $2,000 a month, let's use some round numbers, make it easy. You're only going to get to use 75% of that number. So even though your lease says, hey, I promise to pay as a renter $2,000 a month, they're only going to use $1,500 of actual qualifying income. And being, they assume as a landlord, 25% of that money is going to go toward repairs or maybe vacancies when they move out. It's going to take another month or two to get it re-rented. So they use 75% of that income for rental income, which is normal. So even if you have normal rental properties and you're buying a rental property, that's what they use. So again, it's not impossible, certainly by no means, but it is something that a lot of folks think they want a rental property as their primary home, want to use that rental income to qualify for the next home, find out they can't because they hit the wall with these criteria. So if you can qualify for both homes by themselves, meaning without that rental income, cool. We don't have to worry about any of this. But if you can't, you got to use that rental income. Those are the qualifying factors. So if you have questions, if you want us to talk about your particular scenario, feel free to reach out to the Mortgage Mark team. As always, forward, share, subscribe, all that fun stuff. And then when you think mortgage, think Mark.